Hello, everyone, and welcome. I'm excited to have you here today. We're about to dive into the fascinating world of the share market. The title of our presentation is Understanding the Share Market, with a subtitle of An Introduction to Stock Market Basics. Over the next few slides, we'll cover the fundamental concepts, how the stock market works, and some key terms you should know. So let's get started and make this a really engaging and informative session. So what exactly is the share market? Essentially, it's a marketplace where people come together to buy and sell shares of companies. Think of it as a platform that facilitates these transactions. Now, why do companies want to be part of this marketplace? Well, it helps them raise capital, which is crucial for funding their growth, new projects, or even paying off debts. At the same time, the share market offers investors a great opportunity to grow their wealth. By investing in shares, they can benefit from the company's success over time. It's a win-win situation. Now, the share market isn't just one single place. It's divided into two main segments, the primary market and the secondary market. The primary market is where companies initially issue new shares to the public. This is called an initial public offering, or IPO. Then, once those shares are in the hands of investors, they move to the secondary market, where buying and selling happen among investors themselves. Understanding these segments is key because they serve different purposes, but together make the entire share market work smoothly, connecting companies looking for capital with investors seeking growth opportunities. Let's now turn our attention to the primary market. This is the stage where companies issue new securities for the very first time. It's essentially their debut in the securities world. When a company wants to raise capital, they go to the primary market to sell these new securities directly to investors. The key point here is that investors buy these securities straight from the company, not from other investors. This direct transaction helps the company raise funds to support its growth or new projects. A common method used in the primary market is the IPO, or initial public offering. This is when a private company decides to go public and offers its shares to the general public for the first time. An example of this is Zomato's IPO in 2021, which garnered a lot of attention and marked a significant milestone for the company. Understanding the primary market is crucial because it's the first step in a company's journey to access public capital. It sets the foundation for the company's future trading in the secondary market. So, in the context of our overall discussion, the primary market is where companies launch their securities, and investors get a chance to participate right at the start. Let's talk about the secondary market. This is where the trading of already issued shares happens. Basically, once a company has gone public and shares are out there in the market, investors can buy and sell these shares among themselves. When this happens, ownership of the shares changes hands, but the company itself isn't issuing new shares in this process. The key platforms for these transactions are the NSE and BSE, which are the main stock exchanges in India. For example, if you look at Reliance Industries, its shares are traded daily on the NSE. This continuous trading helps provide liquidity and gives investors the opportunity to buy or sell shares whenever they choose. So, the secondary market is really vital because it allows investors to exit their investments or increase their holdings, making the entire investment process more flexible and dynamic. It's an essential part of the overall functioning of the stock market, connecting the initial issuance with ongoing investor activity. Now, let's take a closer look at the key participants involved in the financial markets. First, we have the retail investors. These are individual investors who buy and sell securities for their personal accounts. They are often the most numerous and can have a significant impact on market movements. Next, we have institutional investors, such as mutual funds and insurance companies. These entities manage large sums of money on behalf of their clients or policyholders. Their investment decisions can influence market trends due to the volume of their transactions. Then there are brokers and sub-brokers. They act as intermediaries, facilitating transactions between investors and the stock exchanges. They play a crucial role in ensuring smooth and efficient trading. Finally, we have regulators, like SCBI in India. They oversee and regulate the markets to ensure transparency, protect investor interests, and maintain fair trading practices. Understanding these participants helps us see how the market operates as a dynamic ecosystem, with each group playing a vital role in maintaining its stability and growth. Let's take a closer look at the different types of investment options available to us. First up, we have equity shares, which essentially mean owning a part of the company. When you buy shares, you're buying a piece of the business and sharing in its growth and profits. Next, we have debentures and bonds. These are considered fixed income investments, meaning they generally offer regular interest payments and are less risky compared to equities. They're a way to earn steady income and lend money to companies or the government. Moving on, mutual funds are an excellent way to pool money with other investors. Professional fund managers then invest this pooled money across a diversified portfolio of stocks, bonds, or other assets, making it easier for individual investors to access a wide range of investments with less risk. Then there are derivatives, including futures and options. These are more advanced financial instruments that derive their value from underlying assets like stocks or commodities. They're often used for hedging risks or for speculative purposes, so they require a good understanding of the markets. Finally, we have ETFs, or exchange-traded funds. These are similar to mutual funds, but traded on stock exchanges like individual stocks. They offer diversification and liquidity, often at a lower cost, making them an attractive option for many investors. Understanding these options helps us tailor our investment strategies according to our risk appetite, time horizon, and financial goals, which ties back to our overall theme of building a strong, diversified investment portfolio. So let's take a closer look at how the share market actually works. First, a company issues shares, which essentially means they are offering a portion of ownership to the public. Then, investors like you and me can buy those shares, becoming part owners of the company. Once the shares are issued, trading happens on stock exchanges, which are like marketplaces for buying and selling shares. The prices of these shares aren't fixed. They move based on demand and supply. If more people want to buy a stock than sell it, the price goes up. If more want to sell than buy, the price drops. Investors make money in two main ways. The first is through capital gains, which means selling the shares at a higher price than what you paid. The second is through dividends, which are a share of the company's profits paid out to shareholders. Understanding this process helps us see how investing in the stock market can be a way to grow wealth, connected to the overall theme of building financial knowledge and making informed decisions. Let's take a closer look at some of the key factors that influence share prices. First, company performance plays a crucial role. Things like profits and losses directly impact investor confidence and, consequently, stock values. If a company is doing well financially, its share price tends to rise. If it's facing losses, the opposite can happen. Next, economic policies are also significant. Government decisions on taxation, interest rates, or regulations can create a ripple effect in the market, affecting how investors view certain sectors or companies. We also need to consider global events. Things like wars, fluctuations in crude oil prices, and inflation rates can have a profound impact on share prices worldwide. For example, rising inflation might make investors cautious, leading to a sell-off, while wars can introduce uncertainty that impacts the entire market. Finally, investor sentiment and the demand-supply dynamics are always at play. When investors feel optimistic, demand for stocks increases, pushing prices up. Conversely, if sentiment turns negative or supply outstrips demand, prices can fall. All these factors are interconnected and help explain why share prices are constantly changing. Remember, understanding these influences is essential for making informed investment decisions and grasping the bigger picture of the market's behavior. Let's take a look at some of the key benefits of investing in the share market. First, there's the high return potential. Historically, the stock market has offered opportunities for significant growth, especially over the long term. Of course, with higher returns comes a bit more risk, but that's part of the excitement and opportunity. Next, we have liquidity. This means it's pretty easy to buy or sell shares when you need to, giving you flexibility and control over your investments. You're not tied down. You can access your money more readily compared to other investment options. Diversification is another major benefit. By spreading your investments across different stocks and sectors, you reduce the risk of losing everything if one particular area doesn't perform well. It's a smart way to manage risk while aiming for steady growth. Then there's dividend income. Many companies share their profits with shareholders in the form of dividends, providing you with a regular income stream in addition to any capital gains. Finally, investing in shares is a powerful way to create long-term wealth. Over time, the compounding of returns and growth of investments can help you build substantial financial security and achieve your future goals. All these benefits align well with the overall idea of making informed, strategic investments to grow and secure your financial future. Now, let's take a closer look at some of the key risks in the share market. First, market volatility. This refers to the rapid and unpredictable price swings that can happen in the market, often driven by investor emotions or external events. It's important to remember that volatility is a normal part of investing, but it can be unsettling if you're not prepared for it. Next, we have the economic slowdown. When economic growth slows down, companies tend to perform less well, which can impact their stock prices. An economic downturn can influence the entire market, so staying aware of broader economic trends is crucial for investors. Then there are company-specific risks. These are risks unique to individual companies, such as poor management decisions, product failures, or financial difficulties. Such risks can significantly affect a stock's value and are why thorough research on a company's fundamentals is so important before investing. Finally, political and regulatory changes can also impact the market. New policies, tax laws, or political instability can create uncertainty, affecting investor confidence and market stability. Keeping an eye on political developments helps investors anticipate potential changes that could influence their investments. Overall, understanding these risks helps us develop strategies to manage them effectively, which ties back to our overall goal of making informed and resilient investment decisions. Now, let's take a look at some of the most popular stock indices in India that are commonly used to gauge the overall market performance. First, we have the Sensex, which includes 30 prominent companies listed on the Bombay Stock Exchange, or BSE. The Sensex gives us a snapshot of the major sectors driving the economy. Then there's the Nifty 50, which comprises 50 companies listed on the National Stock Exchange, or NSE. The Nifty is widely regarded as a benchmark for the Indian equity market's health. In addition to these broad indices, there are sectoral indices like the Bank Nifty, which tracks the banking sector, or the IT Index, focused on the information technology companies. These sectoral indices help investors understand how specific parts of the economy are performing. Overall, these indices are essential tools for investors and analysts to monitor market trends, make informed decisions, and understand which sectors are leading or lagging. They form the foundation of how we interpret the overall health and direction of the Indian stock market. Now, let's take a closer look at the role of SEBI, which is crucial in maintaining a healthy financial market. SEBI's primary responsibility is to protect investor interests. This means ensuring that investors are treated fairly and that their investments are safeguarded from unfair practices. They also regulate brokers and stock exchanges, which helps keep the entire trading environment transparent and trustworthy. By setting rules and guidelines, SEBI ensures that everyone plays by the same fair rules. Another important aspect is transparency and fair practices. SEBI works to make sure that all market activities are clear and honest, which builds confidence among investors. Additionally, SEBI controls insider trading. That's when someone uses confidential information for personal gain, which can harm the market's integrity. Overall, SEBI's role is vital in creating a fair, transparent, and secure stock market ecosystem that benefits everyone involved. Let's talk about some basic strategies that are especially helpful for beginners starting their investment journey. First, it's crucial to invest for the long term. This means thinking beyond quick gains and focusing on steady growth over time. Patience really pays off in investing. Next, diversification is key. Spreading your investments across different assets helps reduce risk. Think of it as not putting all your eggs in one basket. The more varied your portfolio, the better protected you are against market fluctuations. Before you jump into investing, always do your research. Understand the assets you're investing in, their potential, and the risks involved. Knowledge is power, and it helps you make smarter decisions. Another important point is to avoid herd mentality. Just because everyone is investing in a particular stock or sector doesn't mean it's the right move for you. Make decisions based on your own analysis and financial goals, not just because others are doing it. Finally, consider using systematic investment plans, or SIPs. They allow you to invest a fixed amount regularly, which helps build discipline and takes advantage of market fluctuations through rupee cost averaging. All these strategies connect to the overall theme of building a solid, sustainable investment foundation. Remember, consistency and informed decisions are the pillars of successful investing. Let's look at some real-life examples to bring these concepts to life. First, there's Reliance Industries, whose growth story is truly inspiring. They started from humble beginnings and over the years, expanded into multiple sectors, showing how strategic diversification and innovation can lead to remarkable success. Then, there's Infosys, which has been a standout success since its IPO. Their journey highlights the power of technology, talent, and a clear vision in building a global IT powerhouse. On the flip side, we also need to remember cautionary tales like the Harshad Mehta scam. This was a major financial scandal that shook investor confidence and serves as a reminder of why transparency, regulation, and ethical practices are so critical in the markets. Connecting these examples to our overall theme, they show us the spectrum of possibilities, how integrity and smart strategies can lead to growth, but also how lapses and unethical behavior can cause significant setbacks. It's a reminder that understanding these real-world stories helps us make more informed and responsible investment decisions. So to wrap things up, let's remember that the share market is really a mix of opportunity and risk. It offers great potential for growth, but it also requires careful management and understanding of the risks involved. The key to navigating this space successfully is knowledge, knowing how the market works, understanding the companies you're investing in, and patience, because investing is often a long-term game. When you combine these two, knowledge and patience, they become powerful tools for building wealth over time. And really, that's what investing is all about. Staying disciplined, making informed decisions, and giving your investments the time they need to grow. Ultimately, the stock market is one of the best tools we have for creating wealth in the long run. It's not a get-rich-quick scheme, but with the right mindset and strategies, it can be a reliable way to achieve your financial goals. Thank you for your attention, and I hope you found this overview helpful for your investment journey.